Welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we are diving into a topic that every serious trader needs to understand: the winners and losers from the Iran war, and more importantly, what this teaches us about how to trade geopolitics. Geopolitical conflicts have shaped financial markets for centuries. Wars, sanctions, political tensions, and trade disruptions all influence how capital moves around the world. But conflicts in the Middle East carry a particularly strong impact because of the region's central role in global energy markets. Right now, the Iran war is a powerful example of how quickly geopolitical events can ripple through financial markets. When military tensions rise in a region responsible for a significant share of global oil production, traders immediately begin reassessing risk. Oil prices move, equity markets react, safe haven assets surge, and certain sectors suddenly become winners while others face serious headwinds. Understanding these dynamics is one of the most important skills you can develop if you want to learn how to trade geopolitics successfully. Let's start with the big picture. The Middle East is one of the most strategically important energy regions in the world. Countries such as Saudi Arabia, Iran, Iraq, Kuwait, and the United Arab Emirates produce a large portion of global oil supply. But even more critical than the oil fields themselves is the infrastructure that moves that oil to global markets. One location stands out above all others: the Strait of Hormuz. This narrow waterway connects the Persian Gulf to the global ocean and serves as one of the most important energy transit routes on the planet. A significant share of global oil exports pass through this corridor every single day. If anything disrupts shipping in this region, the effects are felt immediately across global markets. That's why when conflict involving Iran escalates, traders instantly focus on the risk to energy supply. Even if oil production itself hasn't been interrupted, the mere possibility of tanker attacks, blockades, sanctions, or military escalation can send oil prices sharply higher. Markets don't wait for the disruption to happen. They price the risk in advance. And that's a core lesson in how to trade geopolitics. Markets move on expectations, not just events. So let's talk about the winners first. Even though war brings devastating human consequences, financial markets still respond according to economic incentives. Certain industries tend to benefit when geopolitical tensions rise, especially when those tensions involve energy-producing regions. The most obvious winners from the Iran war are energy producers. When conflict threatens global oil supply, energy prices usually surge. Traders call this the geopolitical risk premium. It's essentially an extra layer of price built into oil because markets fear potential supply disruptions. Higher oil prices directly benefit companies involved in producing and selling energy. When crude prices climb, the revenues of oil producers increase dramatically. Their profit margins expand, and investors often pile into energy stocks in anticipation of stronger earnings. This means that large integrated oil companies, offshore drilling firms, and oilfield service providers often see their share prices rise during geopolitical crises. But the benefits aren't limited to companies. Oil exporting countries outside the conflict zone can also gain. Nations like the United States, Norway, or Brazil may experience stronger export revenues simply because global prices are higher. For traders trying to understand how to trade geopolitics, the energy sector is often the first place to look. Oil markets tend to react faster than almost any other asset class when tensions rise in the Middle East. Another sector that frequently benefits from geopolitical conflict is defense and military contractors. When wars break out or tensions escalate, governments almost always increase military spending. Countries invest more in defense systems, security infrastructure, intelligence capabilities, and advanced weapons technology. This creates increased demand for companies that manufacture military equipment. Defense firms involved in missile defense systems, advanced aircraft, surveillance technologies, cybersecurity, and military drones often see stronger order pipelines during periods of conflict. What's interesting is that financial markets frequently anticipate these spending increases well before official government budgets are announced. Investors know that prolonged geopolitical instability typically leads to expanded defense budgets, so defense sector stocks can begin rising early in the conflict cycle. For macro traders, monitoring defense stocks can provide valuable clues about how markets expect a conflict to evolve. Another important group of winners during geopolitical crises are safe haven assets. Whenever uncertainty rises, investors start moving capital toward assets that are perceived as stable stores of value. This is a classic market behavior known as a flight to safety. Gold is perhaps the most famous safe haven asset. During geopolitical crises, investors often buy gold as a hedge against both political instability and inflation. At the same time, the US dollar frequently strengthens because global investors view it as a safe and liquid currency. US Treasury bonds can also attract strong demand as investors seek stability in uncertain times. Understanding these capital flows is crucial when learning how to trade geopolitics because these shifts often happen quickly and create powerful trends across multiple asset classes. Another group that can benefit from geopolitical conflict are commodity traders and volatility specialists. Wars tend to increase market volatility across the board. News headlines about military strikes, sanctions, diplomatic negotiations, or ceasefire agreements can trigger sudden and dramatic price movements. These large price swings create opportunities for traders who specialize in short-term strategies. Energy markets, precious metals, currency pairs involving safe haven currencies, and global stock indices can all become extremely volatile during geopolitical crises. For traders who focus on breakout strategies, momentum trading, or macro-driven market moves, these periods can be particularly active. Of course, navigating these conditions requires the right tools. When markets are moving quickly, execution speed and reliable technology matter. If you're serious about trading global markets during volatile geopolitical events, it's worth using a platform designed specifically for traders. You can explore a world-class, cutting-edge, user-friendly trading platform by visiting crystalballmarkets.com/platform. Having access to powerful charting tools, fast execution, and reliable market data can make a huge difference when reacting to major macro developments. Now that we've covered the winners, let's talk about the losers. Because while some sectors benefit from geopolitical turmoil, many industries struggle under the pressure of rising energy costs, disrupted supply chains, and declining consumer confidence. One of the industries most vulnerable to rising oil prices is airlines and transportation companies. Fuel represents one of the largest operating costs for airlines. When oil prices spike, airline profit margins can shrink rapidly. But that's not the only problem. Geopolitical conflict can also disrupt air travel routes and reduce tourism demand. Travelers may cancel trips to regions perceived as unstable, and airlines may need to reroute flights around conflict zones, which increases fuel consumption and operating costs. For these reasons, airline stocks often struggle when geopolitical tensions push oil prices higher. Another group that tends to suffer during geopolitical crises is the consumer and retail sector. Higher energy prices eventually work their way through the entire economy. Transportation costs increase. Manufacturing becomes more expensive. Shipping prices rise. Businesses must either absorb these high costs or pass them on to consumers in the form of higher prices. When consumer prices rise, spending often slows down. Households become more cautious with discretionary purchases, and retail companies can see declining demand. This combination of rising costs and weaker consumer spending can significantly pressure profit margins across the consumer sector. Manufacturing and industrial companies can also face challenges. These industries depend heavily on both energy and global supply chains. When oil prices surge and shipping routes become unstable, the cost of transporting raw materials and finished goods increases. Supply chains can also slow down if maritime routes become dangerous or congested due to military activity. Delays in shipping can disrupt production schedules and increase operating costs. Over time, these disruptions can reduce industrial output and contribute to broader inflationary pressure across the global economy. Another major group of losers can be emerging market economies that rely heavily on imported energy. Many developing countries depend on foreign oil to power their economies. When global oil prices rise sharply, these nations face rising inflation, weaker currencies, and increased pressure on government budgets. Higher fuel costs can reduce economic growth and trigger financial instability. Investors may pull capital out of emerging markets and move it towards safer assets, which can weaken local stock markets and currencies. These capital flows are another important dynamic traders must understand when studying how to trade geopolitics. So, what lessons can traders take from the Iran war? First, geography matters more than many people realize. Certain locations around the world hold enormous strategic importance for global trade. Energy choke points, major shipping lanes, and resource rich regions can become flashpoints for geopolitical conflict. When tensions rise near these locations, markets tend to react quickly. Second, commodities often move before equities. Oil, natural gas, and precious metals typically respond immediately to geopolitical developments, while stock markets may take longer to fully process the economic implications. Third, markets price uncertainty. Sometimes the biggest price moves happen before any actual disruption occurs because traders are anticipating what might happen next. And finally, information and education are critical. Geopolitical trading isn't just about reacting to headlines. It requires understanding macroeconomics, global trade flows, energy markets, and investor psychology. If you want to deepen your understanding of trading, investing, macroeconomics, and financial markets, I highly recommend checking out this podcast series by visiting iss.com/podcast/crystalballmarkets. It offers beginner-friendly discussions and insights designed to help traders build a stronger foundation in financial markets. And that's exactly what we focus on here at Financial Market Insights for Traders. Because the more you understand how global events shape markets, the better equipped you'll be to navigate volatility and identify opportunities. The Iran war is a reminder that geopolitics and financial markets are deeply interconnected. Conflicts can reshape energy prices, disrupt trade routes, influence inflation, and shift investor sentiment almost overnight. Energy companies, defense contractors, and safe haven assets often emerge as winners. Meanwhile, airlines, consumer sectors, manufacturing industries, and emerging markets can face significant challenges. For traders, the key is recognizing these patterns and understanding where capital is likely to flow next. Because in the world of financial markets, geopolitical shocks don't just change politics. They change money flows, market trends, and trading opportunities across the entire global economy. Thanks for listening to Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode.